Hey everyone, this is just a quick heads up that the autumn sale for Snowball Analytics is here with a massive 30% discount. Make sure to jump in early to get the best deals and don't wait too long because it ends soon. Be sure to use my unique link below to grab your discount, and you can even renew your subscription at a lower price, so don't miss it. Earnings season is in full swing here in the UK, and some companies are absolutely smashing expectations. Today, we're diving into the top UK earnings momentum winners. These are companies that have shocked the markets with strong results and impressive growth. Now, you might be thinking, the boat has already sailed because these stocks have rallied, but that's not the case. The data shows there's often plenty of upside left, which is why now could be the perfect time to pay attention. Stick around, you won't want to miss this. Let's dive in. One of the reasons this list is so powerful is because it's backed by Stockopedia's stock rank system. For anyone not familiar, stock ranks are built on three core factors: quality, value, and momentum. The stocks highlighted here are those showing really strong earnings momentum. In other words, companies that are consistently beating expectations and surprising the market with better than expected returns. Now, some people worry that once a stock has already had a good run, they've missed the chance. But Stockopedia's data actually shows the opposite. Stocks with strong earnings momentum often continue to outperform as positive trends carry on and more investors pile in. That's why the names on this list are still such exciting opportunities. They've already proven they can deliver, and the momentum suggests there could be more growth ahead. In Stockopedia's list, there are 70 stocks showing strong earnings momentum right now. Of course, I can't cover them all in one video, so today I'm going to dig deeper into 4 that really stood out to me. But if you are interested in knowing what the rest of the 70 stocks are, then there is going to be a webinar on Thursday the 25th of September between 5 and 6 p.m. and all you've got to do is click the link I've got in the description down below and simply add your name and email to sign up for this webinar. What makes the 4 companies that I've personally picked out interesting is that they don't just have momentum and upside potential, they also reward shareholders with solid dividends. Each of them offer attractive yields, strong dividend growth rates, and a proven track record of consistent payouts. So we're looking at companies that are not only delivering on performance, but also putting cash straight back into our portfolios. That combination of capital growth and income is what makes these 4 especially compelling to watch. So with that in mind, let's get into the details. I'll walk you through each of the 4 stocks one by one, starting with what the company does, why the recent earnings momentum has been so strong, and how their dividend profile stacks up. By the end, you'll see why these names stood out to me as some of the most exciting opportunities from the list. So let's kick things off with the first stock. And the first stock is Balfour Beatty, stock ticker BBY. This is a leading international infrastructure group based in the UK, operating across construction, support services, and infrastructure investment. The company specializes in financing, developing, building, and maintaining complex infrastructure such as transportation networks, utilities, power systems, and social infrastructure. With operations in the UK, US, and Hong Kong, Balfour works on large-scale projects ranging from railways and highways to renewable energy facilities. And they have a strong emphasis on long-term sustainable infrastructure solutions. As we can see on screen, year to date they are up over 37% with a price of £6.28. They are part of the industrials industry, have a market cap at 3.1 billion, went public in 1945, have a dividend growth streak of 3 years and a 5-year dividend growth rate at a massive 17.36% with a very healthy yield that currently sits at over 2%. Balfour's latest half-year results showed strong momentum, with their profit from earnings-based businesses up 7% to 108 million, UK construction achieving its 3% margin target a year ahead of schedule, and support services delivering a 35% jump in profits, largely from power transmission projects. The order book grew by 19.5 billion, average net cash surged to 1.1 billion, and shareholder returns were boosted through an 11% dividend increase and 125 million of share buybacks. These robust financials, combined with record order visibility, improving infrastructure, and energy transition, have driven a sharp share price surge in recent months, further supported by analyst upgrades and growing investor confidence. And as we can see on screen, out of the 7 brokers, 3 still believe they are a strong buy, with 2 having them as a buy and then a further 2 at hold. We can also see that their price target is 646p, which is 2.85% above that current price. When looking at their overall stock rank, we can see they have a stock rank at 83, which is very strong, which positions them in the market at 177th out of 1,447. So with all this in mind, I believe Balfour stands out as a strong UK dividend stock thanks to its resilient business model, diversified operations across construction, infrastructure and support services, and its consistent ability to generate healthy cash flow. The company benefits from long-term exposure to government-backed infrastructure spending, which reduces the volatility compared to pure construction peers. Management has also demonstrated a disciplined capital allocation strategy, combining steady dividend growth with ongoing share buybacks, reflecting confidence in future performance. With their robust balance sheet, a record order book, and a clear focus on delivering sustainable shareholder returns, Balfour offers both income stability and potential for capital appreciation, making it an attractive long-term dividend play in the UK market. The next stock we're going to have a look at is Ramsdens Holding, stock ticker RFX. They are a UK-based diversified financial services retailer combining high street and online operations. Its core business spans 4 main segments: foreign currency exchange, pawnbroker loans secured against jewellery or watches, buying precious metals from customers, and retailing both new and pre-owned jewellery and luxury watches. Ramsdens operates around 160 stores across the UK with a growing online presence to complement its store-based network. They are FCA authorised for their credit and pawnbrokering operations and emphasises sustainable growth, careful store expansion and leveraging its brand and repeat customer base. As we can see, they're actually up over 54% year to date at a price of £3.60, have a market cap at 116.48 million. When public in 2017, have a 3-year dividend growth streak and a 5-year dividend growth rate at 8.25%, with a very healthy yield at 3.5%. And like I mentioned earlier, just because they've been up over 50% year to date, don't let this worry you, as there is still a lot of potential for further growth. Ramsdens' most recent half-year earnings delivered a string of strong positive results. Revenue rose by 18% to 51.6 million, gross profit jumped by 20% to 27.1 million, and profit before tax surged 54% to a record 6.1 million. Their precious metals purchase segment saw gross profit up 53%, helped by high gold prices and more gold bought, and their jewellery retail revenue grew by 18% and pawnbrokering profit also increased, aided by growth in their new dedicated pawnbrokering website. The balance sheet remains sound, net assets rose to 54.7 million, and their net cash is also stronger. The share price has surged thanks to this very strong set of results, the positive momentum across multiple income streams, especially gold and retail jewellery, upgraded their full year profit guidance, now expected to exceed 15 million, and market excitement over the high gold prices continuing to feed into Ramsdens' earnings. As we can see, there's only one broker on here, but they do have it as a strong buy right now, with a price target at around 385 pence, which is around 7% above the current price. When looking at their overall stock rank, we can see it's a massive 98, very close to perfection, which is just another huge reason to potentially consider adding this stock to your portfolio. So I think that Ramsdens is an attractive UK dividend stock because of its diversified and resilient business model, with earnings coming from multiple streams such as foreign currency exchange, pawn brokering, jewellery retail and gold trading, which helps smooth performance across economic cycles. The company has a strong brand presence on the high street, complemented by a growing online offering, giving it both stability and room for expansion. Its exposure to gold provides a natural hedge during uncertain times, while the jewellery retail segment taps into steady consumer demand for affordable luxury. Management has a track record of cautious but consistent growth, maintaining a solid balance sheet and a clear focus on shareholder returns, making Ramsdens a reliable income play with the potential for long-term value creation, especially with that solid 5-year dividend growth rate at over 8% and a very nice yield at 3.5%. The third stock we're going to look at in today's video is Sindall Group, stock ticker MGNS. They are a UK-based construction, infrastructure and regeneration company that operates across a broad mix of sectors in both the public and private realms. It comprises several divisions including construction and infrastructure, fit out, property services, partnership housing, urban regeneration and investments. The firm delivers everything from housing developments, schools, hospitals and transport infrastructure through to office refurbishments, social housing maintenance and regeneration of urban areas. It places strong emphasis on sustainability, social value and local community impact, alongside ensuring quality delivery and maintaining a solid balance sheet. As we can see from the graph, year to date they are up 8.46% with a current price at £42.30. They are part of the industrials industry, which is similar to Balfour, but have a market cap at 1.99 billion. When public in 1986, have a 4-year dividend growth streak with a very nice 5-year dividend growth rate at 16.79% and a dividend yield that currently sits at 3.31%. When having a closer look at this stock on their recent half-year results, it highlighted strong momentum with revenue up around 7% to 2.37 billion. Adjusted operating profit also jumped nearly 40% to 91.8 million, and operating margins improved by almost a full percentage point, all underpinned by a robust 390 million net cash position. The share price has surged in recent months as management upgraded full-year profit guidance, driven particularly by exceptional performance in its fit-out division, where demand for office refurbishments and workspace upgrades remains strong. Coupled with a growing order book, healthy cash flow, and a reputation for disciplined management in a challenging sector, investors have rewarded Sindall for delivering above expectations and offering a more resilient, lower risk profile than many peers. And as we can see on screen on the analyst consensus, they do have 2 at a strong buy right now, 3 at a buy with only 1 at a hold. They also see a price target at 4,855 pence, which is 14.8% above that current price, with a fantastic stock rank at 95. And if you are wondering what is the stock rank and exactly how it is calculated, then that's exactly why you should sign up for the webinar so you can find out that information. So I think Sindall is a compelling UK dividend stock because of its diversified business model spanning construction, infrastructure, fit out and regeneration, which provides resilience across different market cycles. The company has a long track record of disciplined financial management, consistently maintaining a strong cash position and a healthy balance sheet, as highlighted over on Stockopedia. Its focus on regeneration and sustainable urban development also positions it well to benefit from long-term government and private sector investments in housing, infrastructure and workspace renewal. With a culture of operational excellence, a reputation for delivering projects on time and to high standards, and management's commitment to balancing growth with shareholder payouts, Sindall offers investors both attractive income with the potential for steady capital appreciation, especially with this current momentum the company has. The final stock we're going to have a look at is Bakkavor, stock ticker BAKK, This is a leading UK-based manufacturer of fresh prepped foods, supplying chilled ready meals, salads, soups, breads and pizzas, desserts, dips and sauces, and artisan breads. The company operates mainly via private label supply to major grocery retailers such as Tesco's, Waitrose, Marks and Spencer's, and Sainsbury's. As well as supplying some food service businesses, Bakkavor has operations in the UK and over in America, running many factories to produce a wide portfolio of products. In short, it's a fresh, chilled food supply specialist fairly embedded in UK grocery retail, making a large variety of prep meals for everyday consumption. If we have a look at their performance year to date, no shock, they are also up so far this year, being up over 50%, having great momentum. With their current price at £2.20, they're part of the consumer staples industry, have a market cap at 1.27 billion, went public in 2017, have a 3-year dividend growth streak and a 5-year dividend growth rate at 4.76%, with a yield that currently sits at 3.64%, so the highest out of all 4 companies in today's video. And when I dive deeper into their financials, when looking at their recent half-year results, it highlighted solid progress, with adjusted operating profit up nearly 10% to 61.5 million, margins improved to 5.7%, and leverage reduced to around 1.1 times EBITDA, while returns on invested capital also moved higher. The company has sharpened its focus by exiting lower return markets like China, streamlining operations to concentrate on its stronger UK and US businesses, which has boosted efficiency and profitability. The share price has surged in recent months on the back of upgraded full-year profit guidance, clearer margin improvement, and investor optimism around its strategic simplification, further lifted by takeover interest from Greencore that has added speculative appeal to the stock. As we can see on screen right now, there is 3 holds from the analyst consensus and 1 buy, with a price target around about 1% above that current price at 222 pence. If we have a look at their stock rank though, we can see they do have a very solid stock rank at 80, with that quality score up at 90. So this is just another company that I've highlighted in today's video that is on a decent growth streak with a very solid 5-year growth rate and still does pay out a very nice yield. Bakkavor is an appealing UK dividend stock because it sits at the heart of the grocery supply chain, producing a wide range of fresh, chilled foods that are essential to major supermarkets and in constant consumer demand. Its strong relationships with leading UK retailers give it resilience and long-term revenue visibility, while its focus on everyday staples makes it less vulnerable to economic swings compared to more discretionary sectors. The company has also been streamlining its operations to concentrate on higher return markets, which strengthens its efficiency and long-term growth potential. Backed by a disciplined balance sheet, consistent cash generation, and management's commitment to shareholder returns, Bakkavor offers investors both a defensive stability and a reliable stream of dividend income with very solid growth. And that wraps up our look at 4 of the UK's strongest earnings momentum dividend plays. And what ties these companies together is a mix of resilient business models, strong operational performances, and a clear commitment to rewarding shareholders through dividends. Each has proven it can deliver growth while also generating reliable income, which is a rare and valuable combination in today's market. Remember, momentum doesn't end with one strong set of results. History shows that companies on the up often keep outperforming as confidence builds. So if you want to know in more detail exactly why that is, then make sure you sign up for the webinar on Thursday the 25th of September at 5 PM by simply adding your name and email in the link in the description down below. And that wraps up today's video. I hope you've enjoyed. If you did, please like and subscribe. And if you want to see more content like this one, then let me know in the comment section down below. Thanks for watching. This is the Geordie Pig Investor. Over and out.